Hey, have you been following the news
There are too many news.
too many news, yes. So, was it last Monday we were talking about Silicon Valley Bank?
Yeah,
Yes,
and then
yes.
there's First Republic and then Credit Suisse.
Yeah. So, Credit Suisse was actually bought by UBS, right? It went through. The deal
Yeah,
went through.
it went to.
Yeah. So,
Why would they do that?
why do they do that?
Yeah, UBS.
Well, actually, we're gonna. It's there's usually some serendipity in these types of payment things. I will be talking about similar things to what's happening now next week. It was just planned, okay? But let me advance some of that because it is important that you know what's going on. By the way, if you don't know what's going on, you should you should really read about this. Okay, these are the kinds of things that can get you a job. These things come up in job interviews more than how you integrate by parts or things like that. So it seems that the problem with Silicon Valley Bank was that they had a very simple banking business model, which is considered to be very safe. You just take deposits. People give you their money and say, oh, this is great, I have money. And then what do you do with that money? That money, you put it to work somehow, you give loans, you give mortgages, and that spread is what makes banking profitable. We're going to see some examples of that actually again next week. Next week is going to be very significant to understand what's happening today, okay, next week. If you don't have enough business, what you do is you just put that money somewhere. And the safest investment has always been considered to be treasury bills. T-bills, these are the bonds issued by essentially the U.S. government. You saw bonds in your assignment number 1, the equivalent of that, short-term, long-term notes. In their case, they took they had a fixed income portfolio, a bond portfolio, very safe, with a duration of about 10 years. 10 years, this is what the news say, I actually don't know. 10 years duration is the following. I'll explain it to you. Remember when you did your first eigenvector of your assignment number 1? Yeah, what was it? Your assignment number 1, first eigenvector, what was that? You don't remember? You did it yourselves. You're supposed to know. What vector did you get? What? Oh, yeah, they're all basically the same size, right? That means that the fixed income market, a fixed income portfolio is going to be most, the sensitivity that matters the most is to that vector, because that's the one that moves most of the time. And that's a parallel shift. So when rates go up or rates go down, this eigenvector that you calculated is what describes the motion of that space. The duration is, I was not planning to talk about that in this course, is the derivative of your portfolio value to that underlying. Remember the delta, we saw the sensitivity delta for an option portfolio? What was that? That was the derivative of the option price to the underlying stock. Remember that? Okay, so if instead of an option and a stock you have a fixed income portfolio and the interest rate, that first eigenvector, then that derivative is the duration. And the duration measures the sensitivity of your portfolio to that value.
So what's the underlying?
Interest rate. The interest rate, but not as the whole curve, just as, you know, as the rate that moves the curve move up and down. The precise definition of that is exactly your eigenvector in your assignment number 1. Okay. So when you have a mortgage, for example, you have a 30-year mortgage, you can calculate that the sensitivity of that 30-year mortgage to that interest rate is about 15. Is the average time at which you get payments or you make payments. And the implication of that is, I actually have a presentation about this. If you really care, I have a presentation. which I gave in my FIT program last week. If you have a duration of 10 years, you probably know this, that if you have a long-term mortgage and rates go up or down, then your value goes up or down by the duration times the change. So if the change is 1%, your duration is 10, then you lose or make 10%. Okay, so the duration has that amplifier. It's a derivative. It's a derivative. So if your interest rate moves by 1%, your derivative is 10 times 10, then 10 times 1 is 10%. Okay? Yes?
So what's the difference between...
Speak up, I cannot hear.
What's the difference between duration and rho, like rho?
Rho was for a derivative.
Also, just the context is different?
The context is different, yes. It's exactly the same thing. So you can say that the rho of a fixed income portfolio is the duration. There's three definitions of duration: the dollar duration, the modified duration, and the Macaulay duration. They all measure roughly the same thing. One is the change in dollars, the other one is change in percentages. As a mathematician, they should be trivially equivalent to each other, to you. But you can picture this. You have a bond portfolio with a duration of 10 years, which is you bought long-term bonds, not short-term, but long-term bills. And say duration 10 years. How much have interest rates changed in the last year and a half?
5.
About 5%. You're supposed to know these things, by the way, okay? Rates were about 0, and now they're about 5, so 5%. So what's 5 times 10? 50, good. Okay, you can multiply. That means that you would lose 50% if you are long bonds. You would lose 50% of the value of your portfolio in this rally we have seen for interest rates. You understand that? This is all conceptual. I'm not talking about the precise definition, but if rates change by 5% and your duration is 10 years, then the value of your portfolio is going to be 50 times lower. You can say, I don't care, these are bonds, I just wait and then I'll collect my money. Yes, but your actual mark-to-market has dropped by 50%. If at the same time people start taking deposits out of your bank, what do you have to do? You have to come up with liquidity. You need cash to turn the deposits back. If your cash is all in bonds, what do? You have to sell the bonds. If the bonds dropped in price by 50%, you lose 50% of the money. Right? You understand? That's how you think about this. The reality would be different numbers, no derivatives, actual calculations, but this is what derivatives give to you. They give you a way of understanding the amplifying effect of the change of interest rates. And normally, at low rates, the banking business is not very profitable because banks make a profit on the spread. If the rates are very low, the spread also compresses. So banks have been suffering from very low interest rates for a long time. Now that rates are going up, the banking business is more profitable, but on the other hand, if you had your money in bonds, then, well, you're losing a lot of money. Bonds are considered, for me, the irony of the situation, which is related to what I will talk about today. The irony of the situation is, in the investment world, today we're talking about investments. In the investment world, bonds are considered to be the safe investments. Okay? Which I never understood, because they're not. And actually, we just saw proof of that. Right? A bond can be catastrophic. In fact, a lot of the problems we have seen in financial markets in terms of big losses and are related to bonds. Bonds are very tricky instruments because the duration has this amplifying effect. 10 times is a big number, right? If your duration is 10 years. Okay, so you understand? So that explains somewhat the situation with Silicon Valley Bank. I don't know I don't have enough information about Credit Suisse or First Republic or some of the other banks that are being discussed. But one thing which is true and is been hurting investors for about a year is the impact of interest rates going up so fast, and the what that does to bond portfolios. In fact, this idea just occurred to me. Soon, the Canadian pension plans will be publishing their results. They probably already did for last year, and there you can see the effect of rates going up to their bond portfolio. I don't know the exact numbers, but Canada Pension Plan has about $500 million of a portfolio. I guess of that, a lot of it are bonds, right? So if they had lost, like Silicon Valley Bank did, then they would have lost maybe $100 billion or something like that. I don't think they have. I haven't checked. Okay, you can check.
Well,
I'll let you know.
Funds prefer floating rates, so that shouldn't have as big of an impact.
No, it doesn't really matter. It's all in the duration, right? You want to have, if you're a fixed income manager, you want to have, you typically want to have low duration. Low duration means that if rates go up or down, then you're not so much affected by it. Pension plans, what they do is they manage their assets to their liabilities. The difference between Silicon Valley Bank and a pension plan is that the liability of Silicon Valley Bank is unknown. The liability starts when the companies say they want their money, they want their deposits back. These are your liabilities. Canada Pension Plan has much more predefined liabilities. Canadians don't en masse decide to retire tomorrow. That would be a problem, right? But they don't. So they have a much more predictable stream of liabilities, and therefore their asset liability management, which is what's really going on here, is easier to do for a pension than for a bank, which is heavily dependent on deposits being made on the bank. You understand this? This touches on some of the things we have seen in this course, but it only touches. It's somewhat easier than what we have seen here. The one concept we did not see that will explain it very, very well is the concept of duration, which if you're interested, I can tell you tomorrow. Oh, sorry, tomorrow. I have a presentation. I could even improvise it today, but I can tell you more next week if you're interested. But your question, why is Credit Suisse being sold to UBS? I think they're selling for about 15% of the value. So investors, shareholders in Credit Suisse would lose 85% of their value because of that, right? Why? Because it's either that or nothing. If depositors, for example, lose confidence that Credit Suisse is going to stay afloat, what they would do is they would just take their money out, and then the bank would collapse for the same reason as Silicon Valley Bank.
They just let the government bail out Credit Suisse? Is that the thing?
No. Usually, no. We will see what a government bailout is next week. It is actually a part of what I was going to tell you anyway. I'm not sure your understanding of a government bailout, but that usually means that the government buys securities issued by the bank, right? The government will do that if there is no other buyer. If there is another buyer, the government will typically prefer that the other buyers takes care of that. Reason is, if you buy the bank, then you have to manage the bank. Governments don't want to do that. And in fact, it's better that they don't do that. One of the things that is important in this world, that a division between financial power and political power. Many of the scandals that you see all over the world is when political power has financial weapons at its disposal. That's not a good thing. That's not a good thing. We will see next week, we will see how the US government bailed out, in quotes, Citibank in 2009. And then you will understand how that works. It's the bailout is typically done through securities trading, and in this case, if someone else is buying the bank, that's much more preferred for the government. The government does not want to get into the financial business. If no other bank could be convinced to buy Credit Suisse, then the government may do something, like they did with Citibank in 2009, which we'll see next week. In 2008, there was a very interesting bailout that I will also talk about next week, and that was the bailout of Bear Stearns by JP Morgan, very similar to what's happening with UBS and Credit Suisse. The Federal Reserve Bank created the conditions for JP Morgan to buy Bear Stearns, also on a weekend. These things typically happen on a weekend. And we'll see those details also next week. So this is all this is a historical moment. These things happen every 10 years, every 20 years. So my advice to you is to actually spend time on trying to understand what's happening. And by that, if you're interested, I can give you literature. It's very difficult to get information on this. It's all very high level, almost anecdotal coverage in the news. My advice is read the news sources which actually get into what's happening. Like, for example, the Financial Times is very good. It's one of the best sources for this. Occasionally Bloomberg, occasionally the Wall Street Journal. Okay, ignore CNN, ignore some of the other news media. Try to get to the ones that actually give you details about this. That will be useful to you. Okay. More information for you. I have published the second assignment. You should have received a notification. It's also on the website. And I hope it's clear what you need to do. It's not the first time. I had this idea last year, so I assigned it last year. It worked very well. I hope it works very well this year. You have to do a little bit of work. You can start with that now, but as I mentioned, I suggest you only have to submit one page. And that is part of what I'm asking you to do. It's part of the assignment, to do it in one page. And to understand what I mean by that, we'll have to go through the last lecture of the course, which is on, I have a lecture on communication skills and communication something. You will see. So you can start collecting information, you can start working on it, you can start doing, doing what you would consider to be a typical assignment, which is do calculations, do charts. Don't try to put it together into one page until we go through that last lecture. Then you will know how to put it together effectively. Okay, so the fine-tuning of that assignment, I suggest you wait until the last lecture. I gave you April 10th as a date. I don't even know what day of the week it is. I just picked it more or less randomly. I thought last lecture, I think it's a Monday, right? April 10th is a Monday, I think. April 3rd is our last lecture. So I'll give you 1 week longer. I don't want to get into trouble by giving you a due date which is after the end of classes, because then I may be breaking some rule somewhere. So when I say April 10th, I don't really mean April 10th. Could be 11th or 12th. Okay, I don't care. I don't think the TA cares, but I cannot give you a date which is too far into the exam period. Okay, if you ask for it, I can give it to you, but I cannot assign it that late. You could finish this assignment on April 4th, no problem. Okay, a few hours after the last lecture, then you can finish. You can start now and you can finish it then. But I give you 1 week. Should be okay. Okay. And if you have questions about the assignment, maybe after you have a chance to look at it, I can answer questions. I can answer questions next week, the week after, or even later today if you have questions. All right. All good? Yes?
Yeah, so for the presentation of the assignment, we need to take a video or what?
Sorry?
For the assignment, like, it shows that there's a presentation.
One page.
Yeah, I mean, like, we need to take a video, like self-video, to do the presentation.
A video? You want to do a video? You're asking me? No, a one page PDF.
Oh, so,
One page.
Presenting it on one page, not.
yeah, I know. Now you're presenting.
A presentation,
In class.
sorry, a presentation as opposed to a write-up.
Oh.
A one-page presentation, yes, not a, okay, a one-page presentation. Normally an assignment is you write, right? But here I want you to give me like a presentation, and I give you an example. It's on page 2, where it's a presentation, where it's, okay. When you write something, it's linear, right? It's the first word, second word, third word. A presentation is non-linear. Everything is there. Okay. This week, I'm going to start something new. I'm going to start talking about investments. Investments is one part of mathematical finance, which is actually the oldest. It's been around for a long time, but it has not been very sophisticated until recently. Now it's becoming more sophisticated, and I predict that maybe half of you will end up working in it's called an asset management firm. Usually you say investments. Investment is a term which is it's not clearly specified. Asset management is a more generic term. For sure, asset management also includes taking care of a building. That's also asset management. But the sector of asset management is, I prefer to call it asset management. It's more accepted. Investments is one of the acts of asset management. Okay, investment. Sometimes you don't invest, sometimes you go short, sometimes you do other things. So asset management. And I'm going to do that in 3 parts. First part is now until the break. And after the break, so I'm going to tell you how to construct a hedge fund. That's what I'm going to do. You may have heard the term hedge fund. I will show you what they are, and I'm going to show you how, I want to tell you what they are by actually building one. I'm going to build one in front of your eyes. In fact, we can even build it together if you want to. And then we'll take a break. And then after the break, I will tell you about portfolio theory. And that's something which I will do mathematically fairly simple, in quotes. I'll try to do it a bit faster. And that will be the end of today, of this week. And then next week, if I stick to the plan, I've lost half an hour talking about Silicon Valley Bank. Next week, I will explain to you trading strategies. We'll understand how to buy stocks, how to short sell stocks, how to do equity long short, how to do convertible arbitrage, and other things. That's next week. And I will tell you lots of stories, in particular how the Citibank bailout happened. That's all next week. And that will be the end of this course from the technical point of view. And then the last class, which is the one after, is when I will tell you about communication skills, and you will see why. I don't want to talk about that right now. So what I want to do now is I want to talk about hedge funds, what they are, how they are built, and why they are important to you. So I start with this, hedge funds and you, because you're going to be involved with hedge funds throughout your life in different ways, and I want you to be aware of this. So first of all, what is a hedge fund? A hedge fund is an investment structure, an unregulated investment structure. They are everywhere. There is more than $4 trillion allocated to hedge funds, or that hedge funds have that that power. So they are comparable to the GDP of Japan. So think of, the hedge fund space as Japan. It's very hard to go through your life without having anything to do with Japan. So it's very hard to go through your life without having anything to do with a hedge fund. Okay, so for some of you, you may work in a hedge fund. That's rare. There are not many jobs in hedge funds, and the jobs in hedge funds are very typically they are smaller organizations, and they're very careful about who they hire. They want to hire people who are extremely loyal to them, extremely trustworthy, and you may find jobs there. We organize by we as in MMF, we organize an event typically in June every year with the Canadian Hedge Fund Association, one of them. And this is an opportunity for you to see about Canadian hedge funds, what they do. It's very useful, and we usually advertise it, and I encourage you to join. You can join online, okay? So it's something which is good for you to know about that industry. And yes, there are some jobs there. Most probably you will be working in a financial institution, for example, a bank, and then a hedge fund will be your client. Hedge funds have banks as clients. So you will relate to them as your client when you work in a bank. Or you may be working in a pension plan, in which case you will probably invest in a hedge fund. So then they will be your service provider. You will be investing in them. Okay? But you may run a business and then they end up being your competitor. They can compete with you too. Or they can be your counterparty. Hedge funds, they do deals. We're going to see what they do, and then they can be your counterparty. They can be your investor, they can be your client. Maybe some of you becomes wealthy and you want to start your own hedge fund. Maybe some of you, it comes from a wealthy family, and wealthy families are the ones that have created traditionally a lot of the hedge funds that exist out there. So there's many ways in which hedge funds could be related to you, many ways. Throughout your life, they may change. So the origins of this has to do in the 50s. The 50s is when they started, but they really grew in the 80s. We saw that swap, the Rabobank Goodrich swap 2 weeks ago, remember? Why did that happen? That happened because interest rates were very high, there was a recession, and as a way for financial players to navigate the fixed income markets, they needed to get into derivatives and so on and so forth. And look what happened in the 80s. I have here, look at that. There was the consequence of the oil embargo in the US. And in this very pronounced downward trend for stock markets, the private banking departments in the banks, the departments in the banks that take care of the investments of wealthy individuals, they saw that they could, because of whatever reasons, they could outperform the market. So if the market dropped 15%, they could drop 5%. Now the thing is, you may consider a victory to say that I dropped 5% when the market dropped 15%, if you go long the market, for example. But as an investment product, as an asset management proposition, no one likes to lose money. So they started to come up with the idea that if the market drops 15 and you have skilled investors that only drop 5, maybe what you should do is figure out a way to go short the market, and then you end up making 10. Right? Understand? Turns out that in the 80s is when the derivatives markets were becoming commonplace. The exchanges were being developed. So you could actually do that. You could sell futures on the stock indices, and then your minus 5% performance could be turned into a plus 10% performance. Okay? And this is the reason they're called hedge funds, because they were funds managed the way they were managed prior to the introduction of derivatives, but then you hedge the exposure to the stock market, and then you can create performance that will be there whether markets go up or down. That's the idea. Yes? Now, since then, they changed and they do things which are very different, but we will see that next week. Okay, so today my interest is to talk about how these things happen and tell you, there's one concept that I want to say over and over, which is you cannot have performance unless you take risks. That's the way it works. However, because of that, it's very important to understand what risks you take to understand what performance you should get. And what I want to do today is I want to talk about that with an example. There is an equation which is risk to performance, but that doesn't mean that all risks are the same, and not that all risks are good taking. There are some risks that have with them, say, associated risk premia, and others don't. You want to take risks that have associated risk premia. That means that you take the risk, but then that leads to performance. There are some risks that you take for free. For example, if you drive a car, if you don't put your seatbelt on, you're taking a risk. What do you gain by not doing that? Nothing. So don't do it. Simple as that, right? You can take that to most of your activities in life. You smoke, you're taking a risk. What do you get from that? That's your decision. If you get nothing, then don't do it, right? And like that is with investing. Some risks will produce you a performance. Maybe it works, maybe it doesn't work. Then you do them. If they don't give you anything, then you don't do them. You need to understand the equation that brings risk into return. And that's what we will do today. We'll try to understand that equation. And this is the basis for portfolio theory, which is how we will end today. Portfolio theory. And then we will use that portfolio theory to understand trading strategies next week. In doing that, I want to mention here a distinction between two terms, speculation and arbitrage. We're going to use the word arbitrage very often. We've seen the mathematical definition of arbitrage, which is you make money for free. The efficient market hypothesis says you cannot do that. In practice, arbitrage is referred to something different. Arbitrage is you have a very good chance of making money. There is a chance that you may lose, but it's very, very small. Or at least it changes the risk-return equation, and you can substantially increase your risk-adjusted return, and we will define what that means. Okay, so as with everything, once we pass the equator of this course, we stop working for free, and we became more and more focused on the business. And now the definition of arbitrage that we'll use will be more focused on the business as opposed to a mathematical definition that we saw about 2 months ago. Yeah, okay? And in doing that, that's what I mean here. Okay? We're going to take lower than normal risk. We'll see what that means. And there's one aspect here that I want to mention, and that's the role of market inefficiencies. Market inefficiencies get somehow now mixed with information asymmetry. Information asymmetry means that you know something others don't. Of course, there's an illegal aspect of that, like if you have access to what's called insider information, that you cannot trade on it. This is what we saw. This is what the Advisors Act of 1933 prohibited. You cannot do that. But there's information that you may have, which is not insider information. You just happen to say, oh, look at this, I do this and this, so I think this is the right thing to do. Okay? You realize something that other people didn't with information which was out there. This happens. I think we've seen examples of that. You talk to 100 doctors around North America, and they tell you that, I don't think this drug really works. Oh, really? Then this drug doesn't really work. Then you go and short the company that produces it, and you wait for everybody to realize that the drug doesn't work. That's an example, right? Now, to make things somehow easier, I'm going to use an example today, which I think is very good to understand what this means. And I'm going to use this as an example to explain in very simple terms and with an investment exercise that everybody will understand how hedge funds work. We're going to understand arbitrage, market inefficiencies, and risk mitigation strategies through this particular example. So this is an example that I want to talk about. It is one that I like to say It's going to help us understand how a fund works. A fund is a little bit like a company. And like a company, it has a first phase, which is the creation as the idea, what we call the conception. Then it is the birth, and then is the growth, and then is the death. Every fund goes through that cycle. I want to use this example to explain this life cycle to you, how the idea is created, how you turn it into practice, how the fund is born, how the fund grows, and how the fund dies. We're going to see three examples of death today. Fund death. It's just normal. These things happen. All right, so the conception is this. We're in the month of, this is based on a true case, which I like very much to explain marketing efficiencies. So we are now at the end of March. And if we get, this is actually true, if we get a big snowstorm tomorrow or next week, then you will see that the streets get cleaned very quickly. If we get a snowstorm in April, you will see that the snow will not get cleared very quickly. You know why? Because cities, the way they clean the snow, they have a contract with the company, and they tell the company when that contract ends, starts, and when it ends. Some of you may have a similar agreement for your snow removal in your house, if you have one, or maybe your parents do, right? You buy the contract, and between the month of such and such, then they clean the snow, but after that they don't. And I had this idea, I had this idea I think it was 2003, it was one year that we had a very big snowstorm in Toronto in April. And I think may have been my last day of classes in this course or something. And the city was in complete chaos, and 3 days later, the city had to call the cleaning company to get rid of this mess. And they cleaned it. And then it was in the newspapers, they published that Toronto had spent 50% of next year's cleaning snow budget to remove that one snowfall in the month of April. So the city knows that in April you just don't pay whatever it is. And we're going to see some numbers here, right? And say, well, you just don't pay, you just wait. And then when you can't wait, then you have to spend, they probably spend $50 million cleaning one snowstorm's worth of snow, okay? That's the way it happens. But I'm going to use the city of Montreal, because in the city of Montreal, someone had an idea. So this risk can be offset with the risk that ski resorts have. You may have, anybody skis here? You ski, anybody? You go to Blue Mountain or one of the big ski resorts, you go to Blue Mountain, yeah? Well, sometimes, some years we have the opposite effect, which is that the snow disappears very quickly or is very late to arrive. I still remember watching on the news one year at Christmas time, Blue Mountain was just a big pile of mud. There were some people skiing in the mud, but there was no snow, it was very warm. Right? This creates tremendous losses to snow resorts, right? So someone in Montreal had an idea. It's a very interesting idea. It's a swap. It's a snow swap. Footnote, we're going to see more and more weather derivatives as time goes by. And with the climate risk increasing the premium for a lot of these things, these markets will become profitable, very profitable. But this idea was a true idea. Someone had this idea. They went to the city of Montreal, and they went to a ski resort, maybe Mont-Tremblant, I don't know. I'm going to presume it was Mont-Tremblant. And they said, you know what, this is what we're going to do. City, take the smallest fixed cost for your snow cleaning operations. So remove the month of November, remove April, and of course, keep January and February. There's no uncertainty there, right? And this is how it works. We're going to do a swap, and if the ski resort has snow, which you also get in the city, then they will give you money, say $10 million. I'm going to use $10 million because it's easy to do calculations with this number. I'm not implying this was the number that they thought. And on the other hand, if there is no snow, then the city will give you $10 million, which is part of what they save, not having that snow cleaning contract with a particular month. right? So that means that you both lower your risk profile. And I don't know the details of that swap, but I know that the economics worked. The economics worked. And when they were ready to sign this swap deal, they realized that they had not specified where they were going to measure the snow precipitation. Okay? And go, well, that should be easy. Let's just pick a location. They could not agree on a location. They could not agree to measure in Montreal, in Mont Tremblant, halfway through. They couldn't agree. And then the deal was off. Again, I don't know the economics of this, but I'm going to presume that some economics, and then I'm going to assume I was there. I'm going to assume I was there, me. Okay, say, oh, wait, don't go. Here's a deal, okay? I'm going to propose this. You say, give me a little bit of money, give me 10% of the 10 million, give me one, okay? And then I will do the swap you want. I suspect this would work. I mean, it's very rare that a 10% decrease in the economics will make it unfavorable. But it's good for the discussion today. This is now an academic discussion. Everything I told you up until now is real, now it's academic. So let's say that I don't go, you have your swap, you measure wherever you want, you measure wherever you want. And then I will take that risk. You give me 10% and I will take that risk. Understand what I'm saying? Okay. So that means that if the city decides to measure the snow in the city and the ski resort decides to measure in the ski resort, I take that risk. I get exactly the same amount of money from either of them, like Goodrich and Robobank, except the payment is now triggered by a snow precipitation event, not by interest rates doing something or other. And I charge 10%. So I take, well, I have to take $20 million of my money, and then I will make 10% of that. And it's 10% plus interest rates, you understand? They pay me 10%, so if I have the $20 million in a bank account for a year, that gives me 5%, there will be 5 plus 10, 15. So I always talk about 10% as the return in addition to the risk-free rate of return. You understand that? Okay. Is this a good deal?
If they disagree, then you go fast.
Yeah, if for whatever reason there is snow in the city and not in the mountain, I will lose my $20 million. I keep 2. I lose 18 million, right? But yes, I go past. I mean, that would be a bad event for me. On the other hand, if there is snow in the ski resort and no snow in the city, I can collect $22 million, right? So let's see, who is a professional investor here? What would you say about this? Who would invest $20 million in this? We're going to assume we have $20 million, okay? I don't know what it feels like having $20 million, but I'm going to assume 20 million. Who likes this investment? You like it or you don't like it?
I like it.
You like it. You like it. Anybody else likes it? No one else.
We need some statistics. I mean, we need some statistics on how.
Okay, let's do some statistics. You're right. Let's do some statistics. Here are the statistics. I'm going to assume 50% correlation between the precipitation in both places. All right? Why 50% correlation? Because I know 50% correlation. That's my favorite correlation for mathematical calculations. Because that I know we've done the probabilities. We know that they say 37.5% chance that I get snow in both the city and the ski resort, or I don't have snow in both the city and the ski resort. And there's only 12.5% chance I get different snow precipitation numbers over there, right? So there's a 75% chance I collect my 10%, my $2 million, and I'm good to go. But there's a 12.5% chance I lose $18 million, and there's a 12.5% chance I make $22 million. These are the statistics. Are they good enough for you? Good. Now what do you say? Do you invest or not?
Think about it.
You're going to think about, well, you don't have very much time to think about these things, because if you think about this too long, someone else, he's going to come and take the investment from you. No? You still like it? Well, you read this here, perhaps, right? So, no. So what's wrong about this? What's bad about this? You have to invest 20 million. 10% return, we said, is good. The problem is the risk. What is the risk of this? Well, we don't know what the risk means yet, but if we calculate the standard deviation of this deal, we see that the standard deviation is 50%, the volatility is 50%, and there's one thing that we'll understand today, it's called the Sharpe ratio. You just divide the 10 by the 50 and you get 0.2. 0.2 is very small. A number which is less than 1 is considered to be not very good. So this investment is actually not very good. So I wouldn't do it. The risk is too high, as given to us by the statistics, by these numbers that we have here. And you may say, well, why divide this by that? I say, that's a very good question. I will answer that question at 15 minutes to 2 p.m. today. But are you following the logic of this? Yeah? Great. But here's another idea. Again, you have to be smart to have these ideas. Why don't we do 100 of these swaps? I do it in Montreal, I go to Toronto, I go to Calgary, I go to Vancouver, I go to 100 cities, 100 swaps. Say same economics to all of them, right? What happens when I put 100 of these swaps together?
Your expected return multiplied by that factor, but your variance?
Yeah, your standard deviation will drop by a factor of 100, which is 10. So my economics is now 10% return as before, and a standard deviation of 5. That's very good. Yeah? That's giving me a Sharpe ratio of 2. This is a very good investment. It's a very good investment. Shall we do it? Who wants to do it? Great. Anybody has $2 billion. We need $2 billion for this. Do you have $2 billion? No. Well, if we don't have $2 billion, this is just an idea. It's not an investment. We need $2 billion. So this is the conception part. Now we go into the birth part. It's a good idea. Don't you think it's a good idea? Yeah? Shall we do it? We don't have $2 billion, but do you think it's worth doing? How do we do this? What do we do? We had a good idea, and we talked, and we called all of the cities, and they're all happy to do this.
Get a bunch of investors to invest in the idea.
Okay, let's call investors. You know investors?
Do I know any?
Yeah?
I'll try and call some people.
Yeah? Anybody wants to call Elon, maybe? He give us some money? Yeah?
Is 10% attractive enough for people who want to?
Oh, this is a very good deal. This is a very good deal. Yeah. Okay, so what do we called do you have friends? Anybody has friends? Maybe friends in China? Yeah, they want to invest. Yeah? Shall we call them?
Is it legal?
That's a very good question. Is it legal? When you call your friends, what do you tell them, right? What do you say? Call Elon. Say, hey, how you doing? Do you have $2 billion? Can you lend me $2 billion? This is better than Twitter, okay? 10% return, 5% standard deviation.
Yeah, I think this is.
Even if he believes you, what is he going to do? Give you 10 billion? Just like that, or 2 billion? 2 billion just like that? No. You need to do something. You need to do something, okay? And what you need to do is this. You need to build a fund. And that's what I want you to understand. Building a fund is like building a house. You can't just say, oh, yeah, and a shower and a kitchen and the TV room. You actually need to buy a lot of concrete and put it there and buy pipes, and there's a lot of stuff that has to be done. Building a fund is like building a house. And like a house, it has a certain amount of architecture which is required. and you have to pass permits. You cannot just build a house without a permit. You cannot just build a fund without a permit. So I want you to understand this. This is very important that you understand this. Okay? Why? Because many of you have a math background. And as a math background, you cannot ignore the business aspects of this because then not very useful. And because if you have the math background and you have the business background, then you become superhuman. This is good. Very few people have the knowledge you have. So I need you to understand this. So stay with me. We need to understand this, all right? Okay, so the first thing we do is we need to create the so we have the investors. We've talked to them and they said yes. But we can't say anything else. We can't say, give me the money. That's illegal, right? If you're going to get someone, even giving investment advice, you need to be registered for that. So we say, oh, you would do that? Oh, yeah, great. Okay, then what I'm going to do is I'm going to build a management company. I want to build a management company. This management company is going to, so how do I create a management company? Let's say I create a management company. I create a management company and I make the domicile of this management company here in Toronto, okay? Make an Ontario corporation, which is a management company. And I'm going to create a fund. So for that reason, I have to go and I have to register this management company with something called the Ontario Securities Commission. If this was in New York, I'll have to go and register with the Securities and Exchange Commission. And if this was in London, I'll have to register with the Financial Services Agency or something. Depends on where you are, and depending on where your investors are, you have to register with the local authorities. This is like, you cannot drive a car without a driver's license, right? It doesn't matter if you're the Formula One Verstappen or this guy. It doesn't matter. You need a driver's license to drive a car. And if it's a school bus, you need a different kind of driver's license, right? Managing funds is the same thing. You need a license for that. I'm not getting into that. I just need you to know you need a license. So my management company, I'll create that. I can create this company in 48 hours. But then I have to register this company. This could take a year. I have to hire a law firm, spend $100,000, $200,000, $300,000, who knows how much, and then I become registered. It's like I have a driver's license. So I'm assuming this is all done, and I assume it's done quickly. I'm going to assume I already had a management company, so when I had the idea, I'm ready to go. Yeah? Even better. I want you to understand this part of the business. You have to do that. And then I create a fund. What is a fund? A fund is like a company, but unlike a company, it has no employees, it's just a way to collect money from investors in such a way that an external entity, the management company, will manage it. Okay? All right. Now, before I continue, do you know any hedge fund? Have you heard the name of any hedge fund? Citadel. Very good question. Oh, sorry, very good answer. So where is Citadel in all of this?
Oh, well, that's in Florida.
Yeah. Well, no, okay, wait. So Citadel. There is a company called Citadel. Oh my goodness, what I cannot write. Citadel is a hedge fund, right? Yeah. So where is Citadel? Is Citadel this one? Is Citadel that one? Is it maybe this one? Maybe that one? What is Citadel?
Fund?
No.
Oh, well, there's...
It's the management company. Citadel is the management company.
And there's Citadel Securities.
Well, the thing is that when you have a management company, the management company has not one but many funds. Citadel manages many, many funds, right? And all the funds, they have different names. It could be called the spring fund, the summer fund, the fall fund, the winter fund, whatever. Yes? So in this case, this is important. In this case, we create a management company. We call it the what? The APM466 management company. Why not? Okay? Inc. And then we create the Snow Fund. The Snow Fund is here. And the APM466 Inc. is here. Right? Investors put the money where? When you call Elon, where does Elon's money go? Snow fund. So we try to tell Elon to give the money to the APM466 Inc. company. Shall we? Where do you want Elon's money to go?
We have to register the snow fund.
Yes, we have to register the snow fund, yes. Yes. But that's easier. Registering a fund is very, very easy, as long as the company that registered that is registered, right? So hold that thought there, okay? You'll answer this question a little bit later. Where do we want Elon's money to go? Into the APM466 Inc. company or into the snow fund? All right, good. Investors' money is there, the management company is there, and then we're up to the races. Then we can go and talk to all the cities and the ski resorts and do all these swaps. And you know what a swap is? A swap is a several-page contract with a signature page in the end. Many of these swaps, they are so standard, like the one that we saw with Goodrich. There's no 10-page document. These are governed by something called the ISDA, I-S-D-A. I already forgot what it stands for. And then they're all very standard, and then you can do them with an email. Okay, you don't have, because they reference some of the standard swap agreements that exist. But this one is an over-the-counter. It's very innovative. No one has seen a snow swap before. All the conditions, including where to measure the snow, are written on the contract. So this is a contract which is a legal contract signed by the counterparties. Yes? So we go. I need to hire a few people. I need to hire, I'm not going to do all of this myself. This is a lot of work. I need a lawyer. Who wants to be my lawyer? You're my lawyer. Great. Okay, good. I need someone who's willing to go around negotiating all these deals. You are negotiating the deals, yeah? Okay, so you're going to get a lot of air miles, man. You're going to fly all over the country. Wow, yeah. Okay. And I need an accountant who wants to be my accountant. You're my accountant. There you go. Great. And then I'm going to need, what else do I need? Got lawyer. I got the negotiations guy. I need a marketer. Who wants to be my marketer? You are my marketer. Good. You're the smart one, because you're going to make all the money. Yeah, more than the lawyer. Yeah. Okay. Then what's your job? Your job. You're the marketer. Yes. What's your job? You go on TikTok talking about the fund, or what do you do? You call Elon. That's what you do. Okay. That's what you do. You understand what I'm saying? Okay. Do I need a mathematician for this? Do I need a mathematician? Do I need someone from APM466 for this? Sorry? Yes, but what's your job? So I'm happy to hire you, but what's your job description? Sorry, you're going to do what?
Dealing with the numbers to make sure it's a good deal.
You're going to do the numbers, make sure it's a good deal? Why do we want the numbers? Okay, convince me that I need to hire you.
Chris has a good job description for her, I think.
Sorry, what?
Chris has a good job description.
Oh, Chris, a meteorologist. Okay.
Oh, that's a climax.
Okay, okay, I'll answer that question in a minute. Okay, what's your name? Anna. Okay, I'm talking to Anna here. So why should I hire you?
For example, if you want to calculate the volatility and
Okay, great. So why do I want to calculate the volatility? I want everybody to pay attention to this conversation, okay? Thank you, Anna, for asking that, okay?
maybe to calculate Sharpe ratio
And why do I want the Sharpe ratio?
to determine if it's a good deal or not.
To determine if it's a good deal or not. Okay, so let's see. You are the one doing the deals, right? Do you buy her argument? Do you need her, what did you say? Sigma. You need her sigma for your deals?
Well, I need to tell my clients what their variance is going to be.
Okay, really? Do you think the city of Montreal cares about the variance? Do you think Blue Mountain cares about the variance? I don't think so. I don't think they care. They just say, what? Oh yeah, if I snow, who pays all my staff? Oh, I pay the staff. Oh, that's good. Why do I want her sigma there? There's a role for you, okay? Don't despair. Stay here, okay? Don't go, okay? I'll need you. But you need to change shirt. That Stanford thing I don't like. I prefer U of T. But anyway, that's that's okay. That was a joke. Do you need her? You're the one doing the deals, right? Yeah. The lawyer. Does the lawyer need her? Do you need her?
I mean, it might be useful, like, if we get into a problem, like...
You get into a problem, what's the jurisdiction of the city of Montreal? How can she help you there?
Well, I gotta... How can I say this?
Yeah, I don't know.
Well, I gotta tell the city what's my risk, what's the company's risk, for example, right?
Right, why?
Disclose that.
No, the city doesn't care about the company's risk. They get full collateral, so they don't care. They just want to know where that money is. So that's your job. You say, well, the money is here. Okay, that's fine.
The investor wants to know, like the marketer would want that information.
The marketer, that's her, right? So do you want to hire her? You do. Why? She's your friend, or? Okay, speak slowly and loud, because if I cannot hear you, the people on Zoom cannot hear you either.
I'm pretty sure she's really good at math and all of the financial analysis stuff, so that I can make that decision based on her data. And then
Okay.
I can persuade clients.
So, sorry, you were my accountant, right? Yeah.
I'm the data provider, right?
What?
Like, because he wants to measure the variance about
The variance. Well, the variance only matters to convince Elon, right? You don't care about the variance. You're the accountant. You're just counting money, right? Who cares about your sigma? You don't care about the sigma. You don't care about the sigma. You don't care about the sigma either. She cares about the sigma, right? You want to hire her? Well, you're the highest paid employee in this firm anyway, so yeah, sure, I'll hire you. You understand what I'm saying? You understand what I'm saying? By the way, if you wanted to get a promotion, what job would you want?
Good job.
Exactly. No, you see, this is very important. I want this to be perhaps the teachable moment of the first half of today, okay? Because many mathematicians don't think they should be in sales. Yes? Okay. No, don't worry, okay? Don't worry, something is coming, don't worry. The movie is going to end well. But do you understand this, right? Why do people need math?
I think it's
No, hold on. Why do people need math? Sometimes you need math so things work, right? Sometimes you need math to sell something. And the salespeople get paid very well, right? So, yeah, why not? Yes. You learn from her. She's very good at sales, right? But then she's going to be hired by Citadel. So yeah, then you make the big money, right? Well, on the lawyer. Yeah. Now, okay. So your question.
I was going to say math is used to come up with strategy. I think then once it's
Okay, so I'm missing an employee here. I need a portfolio manager, right? How can I manage a fund without a portfolio manager? In fact, the portfolio manager is required by the Ontario Securities Commission. So I need a portfolio manager.
That's the math guy.
What?
Is that the math guy? The math person?
Oh, I don't know. Who wants to be my portfolio manager? You want to be my portfolio manager. What's your job? Your job is to look for the safeguard of the investors. That's your job. Okay? And that's obtaining the biggest return possible and the lowest risk possible. So guess what? You need her too. You need Anna also. So now Anna has, she has to work for her and for you, right? So your job becomes more important now, right?
What job? Broker?
What?
What job? Broker?
No. This is the management company. These are the employees. Let me continue. Okay, so we have a pretty good company. I have about 8 employees. I haven't asked you how much you want to charge me. I think we're in good shape. I'll ask you how much you want to charge me later. Okay? Okay. So this is the employees. Let me to answer your question. We need other companies for the fund. I need a bank, right? Why do I need a bank? To put the $2 billion, right? When Elon sends me the money has to go somewhere, right? So I take the bank. Why not?
We need an,
What?
I mean, we need an like public account so that every investor can know the accounting, like the funding account, so they know how to use these.
I don't understand you.
Because we have a management company,
Yes.
and we have a lot of investors, and we need a kind of the public account in bank.
A
so we-
public account. Okay,
so
okay,
it's
okay. No. So when I open my bank account with this bank called Silicon Valley Bank, never heard of them. Okay, the 2 billion goes into an account there, right? That account is in the name of who? The management company, the fund, or the investors? The fund. If that money goes into an account in the name of the management company, oh, business is over. I close the account, take the money, I'm going to Brazil, good luck. And by the way, you guys, yeah, you're employees, but but sorry. You'll never see me again. See what I mean? Yeah? These things matter. Oh, this, I told you, it's like a house, right? You put the shower in the living room and something doesn't work. Oh, you have a very interesting living room. It's one of the two. Yes? Okay. So that is an account in the name of the fund. Well, you may be talking about something different, which is how do the investors send the money into the fund? So typically, that's not here, but you have to create it's called the depository bank. The investor sends the money to some intermediate bank that holds the money and says, I have this money, and this money is going to go to that fund. And then they collect the money, and then they send it to the fund. And the fund is the fund bank account. So they send it to this bank that we have here, right? But this is not in this. I didn't include all of the details of the fund. I want you to understand the high level. You understand the high level, yes? Good. So I have an administrator, and the administrator is a company whose job is to count the money, because they are the ones to tell the investors, you know what, you're making money. You know what, you're losing money. Oh, you know what, you have no money. That's what the administrator does. Understand? The auditor checks that the administrator didn't make a mistake, and they do that once a year. The administrator will calculate this for a mutual fund every day, for a hedge fund every month. The auditor will check these numbers every year, right? And this is important because you have to file taxes, and then you need to know the numbers are correct before you file taxes, right? Good. And the broker, well, we're doing snow swaps. We're not doing stock trading, but if we were doing stock trading, we'll need a broker too, and other things. So this is what we need. This is the whole ecosystem that we need to build, right? Okay, so who was my portfolio manager? You are. I'm going to need a chief risk officer. Who wants to be my risk officer? You're my risk officer. Okay, good. What's your job?
To manage risk.
To manage risk. Okay, we'll look into that in a little bit. Okay, good. So I got a portfolio manager and a risk officer. Right, perfect. Now, this is good? Yes, you understand? Great. Now, I say something here very important. I say this is conflict-free. It's very important that all of these companies do not collude, that they don't, they, for example, have a, I'm going to ignore the fund structure, and I'm going to ignore this. All right, so let me talk about this. Why are we doing this? I go back to my picture. Why are we doing this? Why are we going through the trouble of creating this fund to make money for Elon and his friends? Why? We take a fee. I haven't talked about that exactly. So see, I told you in this part of the course we don't work for free. No one works for free. So we have to charge a fee. There's different types of fees. In this case, let me just go here. Okay. In this case, I'm going to charge what's called 1 and 20. That means I'm going to charge 1% of the assets we manage and 20% of the profits we make. Okay. So let me walk you through the accounting, and that's what the accountant, that would be you, right? That would be the accountant? Who was my accountant? You were my accountant. Okay, good. So I'm doing your job here. So we have $2 billion invested. We're going to have, let's say we get exactly 10%. At the end of the year, 10%. Then this is the interesting part. The management fee is 20 million. So because it's 1% of 2 billion is 20 million. So the management company is going to make 20 million, which comes from the investors. Right? And then what's the profit I'm making for the investors? It's 180 million, right? So 20% of that goes to the management company too, as a performance fee. So the company makes $56 million. There you go. That's why we're doing this. And note that the investors now, of course, don't make 10%, they make 7.2, right? What are you going to tell Elon when you call him?
This is going really well. This is going really well.
You have to project, like you're singing opera in a big theater, because we can't hear you otherwise.
We're making 7.2% profit.
7.2. You cannot say 10 now, right? You have to say 7.2. He still like it. The Sharpe ratio is what? It's 1.5. It's still good. It's still good, okay? But now, this number was good before, right? But this number is better, don't you think? Let me ask you a question. Who wants to be Elon here? You want to be the investor?
Because I have $2 billion.
Yeah. No, it's a fair answer. In fact, it's the right answer. It's the right answer. Who wants to be the manager here? Okay, so in a certain sense, the asset management world or the investment world is broken up into these types of players, right? You are the investor on the one hand, and you are the manager on the other hand. And the manager goes from having nothing, just a good idea, and making $56 million a year. And I create a company and I hire everybody and this and that. Or you already have the money, and then you're making 7.2% per year. But of course, you continue doing your thing. You continue building your boring company and your Twitter and all this and that, right? This is other people working for you. They're making you money. You don't even have to think about it. And yeah, you pay them $56 million for the money they make for you. Okay? All right. So this is how this business works. And so let's say this goes well, and then let me just move on. Let's say this moves well, and I'm going to. There's a few things that we want to think about this. First is, how much money do we need to do this? I said that we need to invest 20 million. Do we really need to invest 20 million? I have to ask my lawyer. You're my lawyer, right? Can we do with less than 20 million? It's a question for him, because can you negotiate a swap deal with less than 20 million, maybe with 10?
Do you think you can do it? Yeah. I'll trust his word.
Yeah, okay, good.
Otherwise, I'm going to sue.
Why would we want to do this with do we care if we do this deal with 10 million or 20 million?
I get it, because it increases the liquidity risk.
Say that again?
It increases the liquidity risk in the fund.
I don't understand.
If you only do it 10 million, it increases the liquidity risk.
Do you say liquidity event?
Yeah, liquidity risk.
Okay, yeah, no, that's, yeah, I understand what you're saying. Yes, you're right, but that's not what I meant. Okay.
Separate the risk, like I invest this amount of money into a fund. It means that I also take 2% of the risk.
Yeah, so there's a number of considerations here. Imagine I can invest with a collateral of only 10 million, not the full 20. Okay, I convinced the CTO, I convinced them. And then I invest with only 10. That means that I have 2 billion. What I could do is I could now do more swaps, right? Instead of 100, maybe I can do 200. What happens if I do 200 swaps? You, my accountant, what will happen if I do 200 swaps? That's the same. I still have 2 billion, right? But what's that? That's 400 million now, right? So well, the investors will be happy, but how about the management company? Are we happy?
Yes.
Well, what's that number? That number will now be 380 times 20%, right? My profit is much higher, so my performance fee is much higher. So now I'm making how much money? What's my performance fee? 76. So I'm making 96 million. The investors are making money too, but I'm being very selfish. I care about my money now, right? Right? You'll be happy because you can, they have a better story to tell them, right? But you'll be even happier because, oh my God, now we're making $96 million. This is very good. So then what do we say? Well, look, do your best. Go out there, get on the planes again and try to get a better deal, right? Yes? This is how now we're into the fund management business, okay? Now we're into the fund management business. Good. And Anna, what do we need you? In this? Well, we're making $96 million, and I'm thinking, what's your contribution here? It's okay, it's a rhetorical question, okay? Stay alert. There's a question coming to you, okay? I want you to understand this. You will see. Okay, so let me continue. I have here the calculation of what will happen if you can do leverage, if you can do this deal investing less than 20 million. Okay, you can have, it gets very interesting. But let me now move to the causes of death. These funds are great things, but they can die. And if they die, how do they die? So here's, you may know about this guy. Have you read about this? Bernie Madoff. By the way, I'm not reading the chat. Oh, okay. It's winter. Okay, sorry. Do you know what this guy did?
Ponzi scheme.
It's a Ponzi scheme. Yes, yes. Now, a Ponzi scheme is a wonderful thing for the schemer, right? They make a lot of money, right? He had great returns. Fantastic returns.
He had zero volatility, like near zero volatility.
He had no. Of course, he made money every single day. He made as much money as he wanted, right? It was all fake, but he was making a lot of money, right? Okay, so do you know this case? Who has never heard of this name, Bernie Madoff? Just raise your hand. I want to know if you've never heard of this. You've never heard of this. Okay, great. So that was the biggest. I think it was the biggest Ponzi scheme in history. And that's one way you can die. And let me tell you what he did. Going back to this example here. By the way, this guy was very smart. He's the one. I think he created the NASDAQ stock exchange. So he was involved in the creation of the NASDAQ stock exchange. He really knew how securities trading works. So he had a very interesting setup. He had a management company, and he was his own broker. What happens if you're the management company and you're your own broker? What?
You buy and sell securities to yourself, I think, or you buy them through yourself.
Yes, you can do that, but you can do something even easier. You can say you bought something, right? And then you produce a brokerage statement saying that you actually did something you didn't, right? Yeah, yeah. Normally that would be caught where? who will catch that? First of all, you can see this like when you build a house. We build a weakness, and if these counterparties collude, then something bad is happening, right? What? The administrator. The administrator is the one who counts the money. They say, wait. Let me get those statements, right? Wow. Really? What happened in this case? This is less known. But the administrator was a very tiny company, 2 employees, managing 50 billion. 2 employees who clearly, I mean, if you, they had only 1 client. Made up, yeah. So what do? This looks fishy, but if something looks fishy, what do? Right? Because you lose your income. I tell you now, everybody works not for free. In fact, people only do things to make money. And very often, they do whatever to make money. It's the opposite of what we saw in the first part of the course. Everybody was very fair and this and that. Now you make money, it just, oh, this doesn't look good, I don't care. Continue to send me your $5 million payment every year and I don't care. See what I mean? Yeah? Well, that is a cause of death. Another one, just have to go all the way back there now. Another one is this. We could say, you know what? Elon has said this on Twitter. Everybody wants to invest in our fund, right? Everybody's calling you. Oh, I want money. I want to give you money. I want to give you $1 billion, another $1 billion. And then you come to me, I'm the CEO. Hey, wait, look, I have all these people, they want to invest. And there's a lot of money here, right? I have another $2 billion ready to invest. You understand what I'm saying? But I don't have more snow swaps. So what I do, I say, yes, I'll take it. So this was my financials with $2 billion. But let's say I say, no, I'll take it. I'll take, why do I take for an additional $2 billion? Why? See, if I don't have any more swaps, the financials are like this. My management fee is now bigger. It's twice as big as before. My performance fee is a little bit tinier because the performance is a bit smaller. But I make, instead of 56, I make $72 million. So I make $16 million more than before. So I said, yeah, sure, bring all that money in. But then my investors make 3%. And you and I know that this is the last year we're in business, right? Understand what I'm saying? Shall we do it? We went from working for free to now working only for the money. Shall we do it? If we want this to be the last year we work? Yeah. I'm older than you, so maybe I'm more inclined to say yes than you, right? Because you, I mean, well, it may be difficult to find another job for you, right? And what does Anna say, the mathematician?
No, we should do it.
Yeah, you want to work, right? You want to work a little longer, right? How much am I paying you, by the way?
How much?
Am I paying you? Yeah, your salary. We didn't discuss that. How much? How much money? Yeah, you're working for me, right? I hired you as the chief mathematician, right? You convinced me. And I said, yes, it's a good idea to have a mathematician in my firm. So my question is, how much am I paying you?
$10,000 per month.
How much?
$10,000 per month.
How much money per month?
$10,000.
$10,000 per month. $10,000 per month. Okay, anybody has advice for her?
But where is MAP being used in this whole scheme?
She sold it to me, but I'm still not sure. $10,000 per month. I'm making $56 million, right? I have 6 employees in my firm, or 8 employees in my firm. Maybe you can ask for a little bit more, and maybe I'll say yes.
Can't you ask for a percentage of what you make?
Maybe percentage. I'm happy to give her the percentage. She's bringing assets to me. Okay. Do you know? To you maybe. Okay. Do you know? To her, I'm not sure. To her, yes. What's your name? Violet. So Violet, yeah, for sure. I'll give her the money. How much? Yeah, sure. 20% for yours, no problem, right? She's bringing me the money, right? She wants her job. Now she wants her job even more, right? Because going from, say, what did you say, $10,000 a month, that's $100,000 a year, to 20% of the money, 20% of 56 million is?
I don't want to do math.
5.3.
It's more than $10 million. You make $10 million, you make $100,000. Now you want her job. Yes? More than ever. You work for the money. You understand? First part of this course, we work for free. Now we work for the money. You understand the dynamics in my firm now? Yes? Okay, I'm coming to you. But this is another way of death. Okay, you just don't manage the business. You manage the fund, great. Just don't manage the business, right? So, everybody understands this? We're about to take a break, don't worry, okay? But I need to do something very important. Very, very important. Okay, so let me continue. Here's another cause of death. Here's another cause of death. You are reading the Global Mail one day. Happens to be the day is Christmas Eve, 2009, I think it was, December 24th, 2009. And then there's an article this is from the Global Mail, talking about a company called Interwest. Talking about it had a lot of debt, it was going to go bankrupt. Why is this? Who is Interwest? Who is Interwest? Well, I had this was my swap portfolio, Blue Mountain. Okay, we saw it here, Tremblant, Whistler. Okay, who's Interwest? Do you know Interwest? Don't Google it, I'll tell you. Interwest is the company that owns all of these ski resorts. What happens if the company that owns all of the ski resorts goes bankrupt? No payment. Now you pray for global warming. Right? Do you want global warming or let us know? What do you want? I'm talking financially, obviously. No one wants global warming, but what do you want financially? Why? You have to speak very loud because
There's no snow in the city.
there's no snow in the city. You want to pay money to the ski resort because they're not going to pay you money. Remember credit risk? That's how it works, right? When you have a bankrupt company, don't expect money. It's like Goodrich with rates going down or up, right? You want to pay money to the ski resort. You want to pay money to the bankrupt company because if they have to pay you money, they're not going to pay you and you have to pay the city. Aha. Okay, so well, let's say that this was not so good. We lost money. That's our last year in business also, okay? So who was my chief risk officer? That was you, right? No, you were my chief risk officer, right? Man, where were you? What were you thinking? Maybe you should have asked her, my mathematician from Stanford, right there. You understand? Not because she's a mathematician, because she's a good mathematician. She took APM466, so she knows these things. Okay, she can not only do integration by parts and Python programming. She also knows the business, right? You understand what I'm saying? Your job is to fill reports for the board and for the investors and the little marks that your risk is less than something. Okay, but you are the one. If I hire you, it's so that you think like this. Said, hey, wait. Here, no one took into account the credit risk we have with these companies, right? I would not just hire a mathematician. I will hire a mathematician from APM466. You're taking APM466, right? Yeah, good. Okay. So then I hire you for that reason, because you don't know math, but you also know the business, right? And you're doing something that you're not doing. You're too busy selling. Oh my God, you're talking to people, you're going to parties, you're inviting everybody to dinners, right? You're thinking about the portfolio, and you are a great service to him. But this is because you're not only a mathematician, you also understand what you're doing here, right? In fact, what could be your biggest idea in all of this? Because this is an example. We took credit risk for free. I told you about the credit premium. We took credit risk for free, right? Who's paying us to take this credit risk? No one is paying us. This is not where our money is coming from, right? This is a risk we're taking for free. Do you all understand this? This is risk we're taking for free. You see that? This is the risk we're taking here. If my cities have a great credit rating or a bad credit rating, or my ski resorts, that doesn't translate into dollars. So we're taking that risk for free. Bad idea. Don't take risk for free. This is like driving without a seatbelt. Why would you do that? Yes? But maybe you have an idea how we can take some of the risk down or do something with it. Because this is bad. That means that we ignore the credit risk. So maybe the 10% we're making is 10% from the credit risk we're taking, and therefore it is not so good, right? And you're going to have a very hard time, Violet, right? You're going to have a very hard time explaining to your investors what some of them would be very smart. Elon is pretty smart. Said, wait a minute, what if they don't pay? What do you say? You need an answer, right? So you are the source of that. Okay, and I want you to look at her. The role of the mathematician is not just to do integration by parts, okay? You can think, yes?
So even in this case, I don't see how math can be useful, because it's really you need to evaluate the business risk.
Not math, APM466 is useful. Correction, okay? I'm not trying to tell you how math is useful here. I'm trying to tell you how APM466 is useful.
Yeah, but how could we evaluate quantitatively the risk for introvest goal?
No. Wait, are you taking APM466? Yes. No. Sometimes we don't. Sometimes we evaluate, but sometimes we don't evaluate. What would you do? Okay, help me out here. You need to make me look good now, because I'm teaching, not only I'm the CEO of this company, I'm also teaching APM466. What is the great idea you could have here? You've taken credit risk with me. You know how credit risk works. You know, so, oh my God, we're taking risk for free. What should we do here? Oh, that's good. I like that. He loves that too. But by the way, that doesn't affect our risk. That's a good idea, but that doesn't affect our risk. Okay, I'll help you out. What I would do is I would say, what's your name there? Jack? Or Zach? Zach. Tell Zach, say, hey, Zach, wait a minute. You're doing it wrong. They're asking for our collateral, but we're not asking for their collateral. This whole deal is set up wrong. This whole fund is set up wrong. Our deal making is wrong. You have to tell Zach immediately, because you took APM466. You're supposed to know these things, right? Say, Zach, you said you didn't need her, right? Well, just wait until she tells you, man, go and ask him for collateral too. What do you say? Say thank you. And maybe you say, well, she needs to make more than $10,000 a month. That's nothing, right? You understand what I'm saying? Is this role playing useful to you? Good. This is what I want you to understand. I'm done. Okay? This is how the asset management world works from the inside. We created a hedge fund. And if it works, and if we manage it well, and we have people who are alert and they know what's going on, this will live for a long time. Yeah? Okay, now we'll take a break, 10 minutes. So we understand now how investments work, I think this was very useful. What I want to do now is I want to show you how math is helpful in doing certain things which we need. We already saw how math comes into what we're doing. Anna here was our chief mathematics officer in the firm. And now we're going to see how these things work. And I'm going to do this from the perspective of what I call understanding performance. Okay, so I'm doing this from the browser. And I'm just going to go into this. So you may have seen what this is. This is understanding portfolio return. So from the numbers which are given to the investors by the administrator, One of them is the share price. The share price is the value of your investment when you invest, right? And then that will change over time. So the return of your investment is the difference between two consecutive observations divided by the previous one. That's what's called return. And that's how people calculate return. There's a version of that which is the log return, which is defined in a similar way, but it's slightly different. You take the logarithm of the ratio between the observations, the prices. By Taylor's formula, you know that this is very close to RK. So the two returns are very close to each other when the return numbers are small. They're useful. So this is how return is done. All right. Everybody knows this. But what not everybody knows is what to do with this return. Mathematicians know what to do with this return. Statisticians too. And this return is what, since the work of Markowitz, has become the biggest focus of time series. So with time series and looking at a series of return numbers, you can start to do statistics and probability with it. You know statistics, you know probability. So what I'm going to tell you now is not new. You already know this. From statistical observations, you can construct, for example, the histogram, which gives rise to a certain probability distribution, rho in this case. Or you can construct the cumulative distribution function that gives rise to a function f. And f has the property that its derivative is the histogram. So the histogram, which is what statisticians like, is the derivative of the cumulative distribution function, which is what probabilists like. The cumulative distribution function is oftentimes used in finance. For example, we already saw that when we look at the value at risk a few weeks ago. The value at risk was a quantile. In fact, was the quantile function that was made into law and therefore opened the door to many mathematicians to enter the job market in finance. All of this we have seen. What is perhaps not so well known to people outside of mathematics is the role or the relationship between these two perspectives. Statistics is the type of analysis that you do on Excel. It's what deals with real data, whereas probability is the type of approach that you do thinking about mathematical objects. We know that probability and statistics are very strong when they work together. We're going to see situations, if I have time, I'm not sure if I have time today, but there are situations when statistics and probability don't go together. In fact, what people call statistics is not statistics anymore. Many people in asset management, in investments, do calculations which they think are statistical calculations. They're not. It's very easy to trust Excel with an answer, because Excel does not make mistakes when they make calculations. But that doesn't mean that a number given to you by Excel has any meaning. We'll see examples of that. You may not understand what I'm talking about, but I'll tell you that your mathematical skills will become very important when we try to understand how these things work. Here's an example. One thing that everybody does in investments is they look at portfolio statistics. Portfolio statistics is, for example, this one, the mean return. Many people think that this is the definition of mean return. You know that is not the definition of mean return. The definition of mean return is something elevated, which exists in books. This is an estimator of that. And same thing with standard deviation. This is not the definition of it, it's an estimator of that. You know the difference between a definition and the estimator, right? And you know that the estimator estimates, but it's not a definition. And that has consequences. One of the consequences, I have some examples here. I have one here. This is one consequence. I have here, look at this. This is an example of a fund. I have $1, I start a fund with $1. Forget about the snow fund, okay? This is different. I start with $1 and then the first month I'm great. I double my money. I have 2. Then the next month I lose the $1, so I go back to 1, back to 2, back to 1, back to 2, back to 1. Yeah? When you do that, look at that fund, what is the the return series is given by these numbers, 100% minus 50%, 100% minus 50%. The average return is what? 25% per month. Some people are bothered by this. They're bothered tremendously by this, but everybody does it. They only realize the meaning of this when the discrepancy is very high. But everybody does this calculation every day. What's your commentary on that average return of 25%? Any comments on that? Something wrong here? Maybe some of you are advocating, oh, we should be using the logarithmic return, that the average return is 0. And you will be right, but what about 99.9% of the people in the sector that use the simple return? They don't use the logarithmic return. What's wrong here? Is anything wrong? Is there a mistake here? The only mistake, or the only thing wrong, is people's intuition. That's what's wrong. Everybody, not everybody, most people think that if you have an average return of 25% per month, you make money. And that's not true. Statistics and accounting don't get along. They're completely different topics, subjects, ways of thinking. Yes? In fact, you know Ito's lemma, right? We saw Ito's lemma here. We know that if my volatility is 75%, which it is, the expected return should be sigma squared divided by 2 if I don't make money. If my log return is 0, if I don't make money, my average return should be sigma squared divided by 2. Sigma squared divided by 2 is exactly 25%. So this fact that you see an average positive return when you don't make money should not surprise anybody who understands Ito's lemma. Yes? Okay. So that's the first thing. Now this thing gets more interesting and somehow more challenging, and there's another thing. You know, people believe that when you look at this mean, then this mean has some significance. Oh, you know, this is a bad investment because the return is negative. Well, it was very good until recently, then it became negative, then it goes back up. These things, this is noise. It's not clear what this means, right? So there's a certain, especially now, there's a lot of agnosticism as to the actual meaning of the mean return of anything. So there are entire groups of asset managers who just don't believe historical return. It has no meaning to them, right? So does it mean that math is suddenly not useful? No. Here's another example. This is what happens when you do a standard deviation for the same time series. It's not important what time series that is, but what about this? What do you see here? If I tell you that I have a historical, a 2-year time window of the standard deviation, and you get something like this, what's your answer? Zach?
What are the standard deviations of? What ones are these at?
There are some investments, not too relevant. Okay, I just want to say that, you know, when you look at a standard deviation of investments, there could be anything. Could be there's no fund for, okay, just go up and down. That's the mean. The standard deviation has a different behavior. It's never negative, so it goes up and down, up and down, up and down, right? And then still people attach meaning to it, and I wanted to tell you what has meaning and what doesn't have meaning, and the typical mistakes that people make, unaware of what they are doing. Okay, so here, if I tell you that I have a 2-year time window and you get a standard deviation chart that looks like that, what's the answer? Why do you get this thing? Looks like a hat. But what is it? This is you know this. This is the impact of an outlier in a 2-year window, because this is exactly 2 years. That's 2 years. That happens that an outlier entered your sample that happens to be the year 2007, and then 2 years later it leaves your samples, then of course this is a numerical artifact, right? Is there something substantial that happened there, that the volatility came down? The only thing substantial is that you chose a 2-year time window. So 2 years later, after a certain outlier event, it disappears. So this is not caused by financial markets, this is caused by you and your programming decision to include a 2-year time window. If you had taken a 3-year time window, you will get something slightly lower and slightly longer, right? Well, many people don't know this. They think there is meaning here. But you know there is no meaning here. This is just a numerical artifact based on your programming decision to include a 3-year or a 2-year time window. Yes? Math is your superpower, and I want you to be aware of this. That's what I'm saying. Things which like this are, well, but this is obvious, I've known this. Yes, you've known this, but the rest of the world doesn't know this. In fact, the rest of the world doesn't understand many of these things. Now it gets more interesting. Let me take you to, this is what I call averages over time. And this is the beginning of how machine learning actually is useful in this particular case. If I take those time series that I showed you earlier, the one for the mean, full of noise, and the one for the standard deviation made of random choices of a 2-year time window, and now I apply a different perspective to those numbers. I organize them as expected return and volatility in a plane. What I get is this, and now we can see that this is an example of you can turn this into a regression tree. It's a classification regression, right? And you can clearly see that this has high risk, medium risk, and low risk. And this is a type of there is meaning here. This has meaning. And a neural network could turn this into some specific meaning that you can draw from this picture, right? This is a dog, this is a cat, this is a horse. There's no question about it, right? By the way, these are stocks, high risk. These are bonds. Many people are surprised when they see that bonds have higher risk than hedge funds. But after what happened to Silicon Valley Bank, now we're not so surprised, are we? Right? Yeah. So, as you can see, there's I don't know how many thousands of numbers I've shown you in the last few transparencies. And you have the ability to understand these numbers because you know where these numbers come from. Never forget that. And be aware that many people around you will have no idea where these numbers come, except they come from Excel. Yeah? Numbers need to have meaning to be significant. If they have no meaning, they're just calculations, and then they could just as well be random. Okay. Now, this is important because I have another example here. I have, see, if I imagine this fund I have here, you know, I have $1, I make $1 like before, but now I keep doubling. Oops, I think I've lost the audio for my Zoom. Just see. Oh, no.
Sound is gone.
What? Sound is gone. Yes, sound is gone. Okay, it should be back. Yeah, it should be back. Whoops. No, my iPad is gone. Oh, my iPad is back. Everything is back. Good. No, my sound is gone again. I don't know. Sound comes and goes. Okay, I'm back. Good. It's reconnected. Something about the Wi-Fi maybe. All right. You can see the drill, right? My fund keeps doubling every month. My return is fantastic. My cumulative return is fantastic. But then, in the month of December, Elon decides to give me $1 billion because my return is so good, and then I lose half of it. Right? What does that do to my cumulative return? It barely changes it. Pre-Elon, my return was 204,000%. After Elon, it is 102,000%. I still lost $500 million because this is nothing, right? Very small amounts of money. What's wrong with this? Nothing is wrong with this. The definition may be wrong. Your choice of calculation may be wrong. Nothing else is wrong, right? Again, you need to understand the numbers and what the numbers mean and where they come from, right? Now, because of that, some people have proposed that you use what's called the time-weighted rate of return, which is this. Sorry, the internal rate of return. It's like that. Say, well, wait a minute, let me do something here. Let me look at the cash flows in my fund, in and out, and then the return on my fund is that number such that if I compose the cash flows, I get my final valuation. Not that this is the same definition as the yield of a bond. It's implicitly defined by the equation. There's no formula for it. It's implicitly defined by the equation. And when you use this one, you would see that in this example I have here, my internal rate of return is minus 50%. Oops, this is wrong. I'm using the wrong. The one on the, it's old. Okay, I have to replace I'm using the one on the website. It's old. I have to put a new one, okay? And it has more mistakes, which I've already corrected, but I didn't update in the website. But you'll see that, right? So like this, there's a million counterexamples I could give you. So that's why it's very important that when you do something, you understand what the numbers mean. And going back to our little company that we had here, the APM466 Management Company, Inc., okay, that's your role, Anna. You're the one saying, wait a minute, you're using the math wrong, okay? Okay, all right. So let me continue. So you know the definition of correlation and covariance, yes? All good, yeah? Mm-hmm. Good, I'm not going to spend any time with this. And the first application of correlation is that is the impact it has on the calculation of portfolio volatility. So if you have a covariance matrix of assets that you can invest in investments, and you have weights that you put into each of those assets, the portfolio volatility is this very simple matrix multiplication expression, where you multiply the variance covariance matrix times the weight vector to the right and to the left, and you take the square root. You may also have seen this as the result of the volatility of if you add Gaussians, you know that the sum of Gaussians is a Gaussian. The volatility of that is given by this. So this is an ubiquitous formula. It appears all the time. And from here we can see easily that when correlation is less than 1, then the portfolio risk goes down, which is the only thing you have which is given to you for free. Okay? In this passage, within this course of working for free to working to get paid, only one thing is given to us for free, and that's diversification. This is what diversification means. You can lower the risk, which now we know is as good as making more money, and that's free. That's why in the world of investments, there is such a big quest for diversification. The quest for fire of millions of years ago has now changed into the quest of diversification, which is what you have when you're trying to invest. Because diversification decreases risk, and that we already know if you can decrease risk, that's arbitrage. You can make more money, right? That's our perspective. That's what's so important. And this has many applications. We will see this next week when we see the trading strategies. Today, I want to focus on the work that Markovits did. And this is the work that Markovits did in 1950, which is what earned his Nobel Prize in 1973 or something like that. Then what he did is, said if I take, for example, a stock portfolio, it has a certain return and standard deviation. If I add bonds to it, then the return comes down a little bit, the standard deviation comes down a little bit. if I add a lot of bonds to it, then I have very low return, very low risk. But actually, this return here is better than this one. This is my bond portfolio. So bonds and stocks in certain proportion is better than bonds alone. I don't care who you are. The standard deviation is less and the return is higher. So he says a rational investor will never invest there, never. You invest there, or there, or there. From between here and here, we don't know. But here, no. This is suboptimal, right? So he came up with the concept of investment optimality, which is to say the outcome of an investment is the expected return and the expected and the standard deviation. That's it. Which was a big change from a one-dimensional way of thinking, which is I invest in the best stock. That was the thinking at the time. Said no. There's uncertainty in that in those returns. We don't know what they are. If uncertainty should be dealt with the standard deviation. That was what he proposed, and from that perspective, your investment decision is not one-dimensional, it's two-dimensional. So he made portfolio theory two-dimensional, up from one-dimensional before him. Okay, he never said this is the best thing you can do. No one knew what the best thing we can do. This was better than what was before. He was criticized very heavily around the year 2000 because the standard deviation did not work as a measure of risk. I don't know what that means, but he was criticized. The thing is that the only thing he did is he took a world that was one-dimensional, that was the only dimension before him, and include the second dimension. Of course, we know that our work does not end with two dimensions. We need to start alert, and imagine that on top of this there could be lots of other things, like for example the cities and the ski resorts defaulting on their obligations. That's another dimension which is not even here. We know that. Okay, but going from one dimension to two dimensions signified the Nobel Prize for him. I want you to know that. Okay? But he never told you where, sorry. So from here, you can generalize this. You can take this to greater heights and to say, if I make a picture of all the possible investments I can have, some investments are here, others are here, others are here. These are all my possible investments. Right? There will be investments which are just too good to be true. There is nothing in some region of the space. So the plane is broken up into two regions, one which has no investments in it and one that has investments in it. Right? Basic point set topology, that's what it is. So then his conclusion is the rational investor will invest in the boundary of that set. Anything in the interior is suboptimal. According to him, you would never invest here because you can invest here or there. One gives you the same return, lower risk. The other one gives you the same risk, higher return. Right? So he said you invest here. Where? He didn't say. He said that is a function of the investor's risk aversion. If you are very risk averse, you invest here. If you're a risk taker, you invest there, but never here, never here. That's what he said. All right? Okay, so that's what he did, and then Richard Sharp came later and said, no, I'll tell you where to invest. And then he came up with the Sharp ratio, which already came up as earlier today when we were determining if the swap was good or bad. And I want to explain the Sharp ratio to you, but I want to do it in a very practical context, which is I want to offer two employment contracts, and that's how I want to explain it to you. So I want to do this in 10 minutes. I need to hire two people to manage money. You have one over there, another one over here. Okay, so I give you your first job, okay, which is you're going to manage a portfolio. Let's say it's $1 billion portfolio, okay? And then I pay you a little bit. I pay you $10,000 a month, like you. But if you make 5%, I give you $1 million. You make 4.7, you're stuck with your $10,000 a month. You make 5.1%, you make $1 million on top of your salary. Yes? Okay, I'll stay with you. I'll tell you your contract later. So that's your employment contract. By the way, many employment contracts in the asset management world work like that. So you show up for work one day. What time do you show up for work? What time do you show up for work? I couldn't hear you. What time?
What do you mean by what time?
At what time do you go to work? I mean, I just hired you, right?
Go to work at 8.
8? 8? You go to work at 8? What do you think of that? What time do markets open? 9:30, right? You go to work at 8. What time do people go to work? You know? I don't know in Toronto. If you go to Wall Street in New York, you can see what time people go to work by looking at the opening hours of Starbucks. You can actually do that on your phone. Look for a Starbucks in Wall Street, and you can see what time they open. They open at 6:30. Starbucks open at 6:30. Okay. By the way, what time do you think Starbucks open in the financial district in San Francisco?
They close. They even close.
They actually close, yeah. What time do you think they open? San Francisco? 3:30. 3:30 a.m. Of course, the same time as people go to work at the same time, right? If you go to work at 8, you already have a disadvantage with everybody else, right? They have 1 hour ahead of you to read the news, understand what's happening with Credit Suisse and UBS and Silicon Valley Bank and First Republic. They have all the news. They already know what they're going to do. And you show up there and then, oh my God, no good. Okay, so you go a bit earlier. But anyway, that's okay. What do you do? First day at work, what do you do? You're looking for the portfolio that will give you $1 million, right? To you, the investors, who cares? You, right? You think of your $1 million, right? So here's a way to think about your $1 million bonus. You want to find a portfolio. You see, what we do here is we're mathematicians, and when we're looking for something, we don't know what it is, we give it a name, typically a Greek letter, right? So you don't know what it is, you call it pi, capital pi. That's the portfolio you want to build. And you're focused on that. You want to make 5%. Your R is 5%. And well, see, I don't know what that is, but you notice that your portfolio will have a mean and a standard deviation. You also don't know where they are, so you give them a name, another Greek letter, mu and sigma. So the probability, that event that gives you $1 million is the same event as that, which you can write down with the cumulative distribution function of the Gaussian, right? And this is great because now, see, this portfolio has disappeared from the equation. You don't need a portfolio anymore. If the return is Gaussian, you don't need a portfolio anymore. And what you realize is that maximizing that is the same as maximizing that, which is the same as maximizing that. And this is the subratio. That's why the subratio is so important, because people get paid to maximize the subratio. Indirectly, your contract doesn't say, I'll pay you to maximize the subratio. They say, I give you $1 million, you make 5%. It's the same thing. You see? If my portfolio is Gaussian, it's the same thing. Except the subratio there with 5%, that's your benchmark, is not the risk-free rate of return, as people usually define the subratio. In fact, as Sharpe himself usually defines the subratio. The one that you care about is the one where that is your benchmark. That's the one in your employment contract. And that's what you want to do. You want to maximize that. Okay, so that's what you do. Now, I'm going to give you another job. Your job is going to be very similar. I give you $1 million, also $10,000 a month, but $1 million if you can beat, say, the S&P by 5%. See, the same argument as with her doesn't work, right? Because your benchmark is now a variable, it's a random variable, it's not a number. But it will work if I write the S&P return there, I take the S&P return to the other side here, and then the same thing works. But now what I want to maximize is something that looks like a subratio, but in the denominator, what I have is the standard deviation of your return with respect to the subratio, which is called the tracking error. This is very interesting because you need to have a small tracking error, otherwise your $1 million is at risk. That means that if your say the portfolio, so the S&P is down by 5% and you're up 5%, you'd probably be fired. See that? Why? Because when you may have correlation 0 to the S&P, so when the S&P is up 5, you'll be down 5, and then you're really fired. See what I mean? Right? So you are going to be very interested in having a very low tracking error to the Sharpe ratio. Sorry, to the S&P 500, to your benchmark. Yeah? So these are two optimization problems for portfolio optimization which are 100% linked to your employment contracts, how you're paid. And that's how people trade. That's how people trade. And now this is the interesting part. Do you know the solution to your optimization problem? It's very simple. And I'm giving you an approximate optimization, right? What you do is you put all of your money on S&P futures. You know that when you put all your money into S&P futures, you only have to put margin against that. It's a futures contract, you only put margin, right? Margin is very small, it's 5%. So what you do is you take the S&P futures, but you have most of your cash still there, right? So now what you do is you need to make 5% on the cash, right? Because the S&P return is already guaranteed by the futures contract, right? So what you do is you hire her to manage that for you, and then you go on vacation for a year. See that? And you say, well, if you make 5% on your money, you give her $500,000. You give the other half. You understand what I'm saying? Would you do that? You say, no, I don't want to give her any money. I want to keep all the money by myself.
If I lose that $1 million, I still we give her $500 million.
No. You give her money if she makes the 5% for you, right? She makes 5%, you make $1 million, and then you give her $500,000. And for you, it is, oh, that's great. You know, he doesn't have to give you an additional salary. You already are happy with the $10,000 a month. Your bonus just went up from 1 million to 1.5 million. So you win and you win because you go on vacation and just live in a beach for a year. You see what I mean? And, you understand? Well, so I'm exaggerating now a little bit, but this is how I want to end today. I'm exaggerating because I can tell you now that because of this, we can divide up the business of asset management into the people like her. Your name? Nicola. Yes, of course. I didn't recognize you. With the mask. We divide up the asset managers into the people like Nicola who work hard to make what's called a cash benchmark or absolute return. Like, doesn't matter what happens out there, I have to make my 5% return, right? Or people like you, your name? Yancy, that's right. And they say, well, look, I just need to beat my index. So I do something which looks like a futures contract, and then I outsource the rest of it to her. You're a beta producer. Beta from linear regression, alpha plus beta. You're the alpha producer, you're the beta producer. Right? So in the world of asset management, you'll see alphas and betas. Alphas like you, betas like you. Right? And a lot of the beta is actually done through what's called a portable alpha strategy, which is someone else is producing the alpha. There are people who are experts at producing alpha, like you. And then you're the ones who say, well, but my investors really want S&P returns, just better. So the better part is your responsibility, and you're the one who just focuses on what your investors want, which is the beta part. See?
Why would he be in the loop? Why don't people just go to the alpha seeker?
Because most people are, well, most people don't go to the alpha seekers. They go, if you look at all of the Canadian mutual fund industry, which is where most of the money in Canada is. Very few people go to the alpha seekers, right? You will see that people just want to be the TSX. Yeah, that's what people want. That's what people want, you know, because they know that long term, the TSX is where you want your money to be. So, yeah, I'm not going to talk about the investor psychology or what the investors want, but that's how this business works, right? And this is what I'm describing here. So this is something which is, that's portable alphas I described, and that's how the world of investments is broken down into alphas and betas. And there's a linear regression component to this, which you can see in the, if you want to read it. I want to skip it, but there's an there's a linear regression perspective to explaining this, which is why these things actually matter. Okay, so I think we've learned a lot today. I think, okay, we've seen how investments are made. We see. I hope I demystified a lot of the quantitative aspects of investing. Okay? At the end of the day, what matters is that you have to be smart. That's what matters. And math is there to help you be smart, but math is not the objective. What we're going to do next week is we're going to see how this way of being smart translates into doing specific trading strategies, things that people actually do. So today's, despite the fact that we built a hedge fund, today's class was still fairly theoretical. Even my hedge fund was a metaphor, right? So it was theoretical. What we will see next week is very practical. We'll see examples, how things work. And that will, I think, will give you a very good overview of how the sector of investments actually works, which is where I predict that about half of you will end up finding your career. Okay? All right. I needed some time to put all my equipment away. So is this, any questions? Is this all good? On Zoom? Okay. So I'll see you next week. The assignment is there for you. Start working on it, and we'll continue next week. Bye-bye on Zoom.